So who owns Tesla? The chairman of Tesla.
Elon Musk.
Yeah. Elon Musk, right?
Elon Musk.
Yes, you're right. Good. Now, look at, well, I brought this up because the Sri Lankan stock market is also going into a bull run, right? So there may be opportunities. Okay, now look at this. If you all had the option of investing or buying a car, a Tesla car in 2012, it would cost you $77,000, right? Roughly with that same amount, you could have bought 11,390 Tesla shares. So this was way back in 2012. So if you had kept it for 8 years, in only 8 years, your car will drop in value, right? It will drop to about 50%, less than that of the value, 40% of the original value. But what happened to the share price? $77,000 have increased to $6.6 million, right? So every decision you make in your life will have a huge impact later on. Those who bought this car in this example would have seen their net worth dropping, right, going down by 50%. But instead, if you hadn't bought a car and you had wanted to rough it out, go by bus, you have 77,000 and invest the money in the shares of Tesla, the value of shares would have increased to $6.6 million, which means you could have bought so many cars, not just one, along with a mansion, right? Now, only thing is in Sri Lanka, it goes the other way around because car prices don't go down. In here, it will double, maybe triple, or go up by 10 times, right? But of course, there is always opportunities in the stock market. Yeah. It's interesting. When there are opportunities, you have to make use of it. Okay, so last week we were on to fixed income. If I just quickly run through what we were doing, we had a very basic introduction of fixed income and why governments issue fixed income or bonds. Even corporates issue bonds. The corporate bonds are called debentures. Then we moved on to the risks of investing in fixed income, how interest rates are determined, why governments issued debt securities, right? And I believe we stop here. Or did we go beyond this? Hello? Did we discuss primary markets and secondary markets?
No, sir.
Okay. Right, primary and secondary markets. So what's primary and secondary? What do you mean by primary markets? What is a secondary market? What is a primary market and what is a secondary market? Any idea?
Where the securities are created is called the primary market.
Yeah.
where the securities are traded is secondary markets.
Okay, very good, very good. I'll explain using an analogy, right? Now, when you get married for the first time, then you're trading in the primary market. Then, when you get married for the second, third, or fourth time, or whatever the time, anything after the first time is called secondary market. Right. So that is the basic difference. Now, in finance terms, when a security, as you rightly said, when a security is issued for the first time, it is issued in the primary market. Right. So if it's a bond, then you go for the primary auction. Or if it's a share, it is issued in the initial public offer. Whereas after the primary, once it is issued in the primary market, then subsequent trades happened in the secondary market. All subsequent trades are secondary market transactions. Right. Government securities are initially issued at primary auctions. Potential investors bid through primary dealers. Right. Now, everyone is not allowed to participate at these auctions. Only primary dealers have the authority to go for bids, to bid at auctions. Who in turn submit, primary dealers in turn submit competitive bids electronically to central bank. Central bank will accept the lowest bid because central bank in this case is borrowing. They are the borrowers, so they will accept lowest bid, meaning the bid that has come with the lowest interest rate, right? So if three people are subscribing for the are bidding for the auction, and if the first guy has gone to the auction at 1 billion at a rate of 5.25, the second guy another 1 billion at 5.5, the 1 billion at 5.75, the central bank will accept the lowest interest rate first, right? 5.25 will get preference. Then if they need further money, they will go to 5.5. Anything beyond, they will, if at all, they will go to 575. Right? So the average will be the weighted average of the auction, which in this case comes to 5.5. Right now, okay, I can explain using an example. So let's say there are three banks. So this is the treasury bill primary auction. This will be the primary dealer. Amount and the rate. Let's assume there are four primary dealers bidding for the auction. First one, let's say, bids 1 billion. Let's say the rate is 5.25. The second primary dealer bids for 750 at the rate of 5.3. Third one, 800 at 5.2. And the fourth bids for 500 at 5.4. Okay. So the total bids received will be 3,050,000,000. And if central bank wants to accept 2.5 billion,
Sir, can you please expand the word? We can't see.
Which one?
We can't see the words in the Excel sheet.
You can't see it.
If you can increase the font size, it will be clear.
Yeah, can you see now?
Yes, sir. Thank you.
Thanks. Okay. So let's say central bank has accepted only 2.5 billion, right? So which one do you think, which bid will get accepted first?
C.
Very good. How much? What amount? Yeah, central bank will look at the lowest bid, right? The lowest interest rate they have received is 5.2, so they will accept that first. Okay, now central bank borrowing requirement is 2.5 billion, and C is bidding 800 at 5.2, so they will take the full 800. After that,
A.
yeah. A, what amount?
1,000.
What is the amount? Yeah, 1,000. Okay.
1,000.
Okay, so they have so far 1,800. They need 2,500. What comes next?
B.
B. Correct. What amount? They need to raise 2,500. They have 1,800 so far.
700.
Yeah, B is bidding for 750, and central bank will accept 700. Right. So the total comes to 2.5 billion, which is the requirement. And what about the amount rejected?
$50 million from B and 500 million from D.
From A, 0. B will be 50. And the full amount of D will be rejected. Now, how do you find the weighted average? The weighted average at this auction? It's the amount accepted multiplied by the rate. And finally, this one divided by the amount. Weighted average is 5.25. Clear? Understood? Any questions? Yeah.
So it means now B's rate is 5.3 now.
Yeah.
Then B will be paid only 5.25 or
No.
weighted
They
average
receive,
is.
yeah, they will be paid, but at the rate that they are bidding.
Right. Okay.
So A will get 1 billion at 5.25, B will get 700 million at 5.3, and C will get 800 million at 5.2. Okay, so that's how it will go. Okay. So in this case, B will be getting a rate which is higher than the weighted average at the auction, whereas C will be getting something lower. Okay. And then central bank will publish the results of each and every auction. Okay, so this is what the central bank will publish finally. The results of each and every auction. Now in this case, the 91-day auction, the central bank was offering 16 billion. They have received 43.9 billion. Out of that, 33.3 billion accepted at a weighted average of 587. Okay, understood. So this will be published every Wednesday. Treasury bill auctions are held every Wednesday. And if it's a bond auction, it will happen on twice a month. Right? So bond settlements are on the 1st and the 15th of every month. Clear? Any questions, Doctor? Bill auctions are usually held on Wednesdays and settlement occurs on Fridays unless it's a holiday. Bond auctions are settled on 1st and 15th of a month. Auctions are held 2 working days before the settlement day. Government securities subsequently trade in secondary market, which is an over-the-counter market. Right. So there are 2 types of markets: over-the-counter and exchange traded. What are the differences between over-the-counter and exchange traded? Differences between over-the-counter and exchange traded markets. Over-the-counter means, now, if you want to buy a loaf of bread, right, you don't go to the stock exchange. You go to a small card and buy, right? But if you want to buy shares, then you can't go to a food city or a card and buy. You have to go to the stock exchange, right? So those 2 kind of markets. So what is the difference between buying from card and buying from the stock exchange? Hello. Yeah, over the counter versus exchange traded. What are the differences? And these are the things that can be tested at the exam.
Over the counter freely available. Means whenever we need, we can go and buy.
Okay.
Buying and selling happen simultaneously.
Yeah. But over the counter markets, if you want to buy, let's say, shares, you want to buy, let's just assume you want to buy shares of John Kears, right? Or you want to buy shares of LOLC or Expo Lanka, right? These shares. If you want to buy these shares, can you ask for 1.5 shares of LOLC? 1.5 shares, can you ask? Can you buy 1.5 shares? Can or can't?
Can't.
Can't. But if you want to buy sugar, can you buy 1.5 kilos of sugar or 1.3 grams of sugar? 500 grams of sugar?
Yes.
You can, which means over the counter can be customized. Whereas exchange traded are always standardized. So the LOLC share that you buy is the same as the LOLC share that I buy. Everyone gets the same kind of standard. It's standardized. Whereas over the counter, it's customized. What else? Now let's assume you're selling your car, right? So if one guy promises to buy the car and you trust the fellow, so you give him the car today itself, can he default? Yeah. Can default happen in over-the-counter markets?
Yes.
Cannot.
Yeah, can. Means the settlement is not guaranteed. But when you buy shares, are you guaranteed of getting the money or getting the share or not guaranteed? There is no guarantee. Is there any doubt that you will never get the shares? There is no doubt. Because the settlement, the exchange, guarantees settlement. The exchange guarantees settlement. Okay. Anything else? Buy sugar, right, or buy a loaf of bread. Do you have to be registered with the supermarket or the gummy cuddy or the bakery?
No.
You don't have to, no? Usually, it's not required. Registration. Meaning you can just walk in and buy. But if you are buying shares, can you buy shares without a CDS account? Or without a stockbroker?
No.
Right, so you need to be registered with an exchange. All right. Yeah.
So over the counter can be done. There's no time period for over the counter transactions. Sorry, over the counter markets.
Time period meaning like T+3 for settlement.
Yes.
Yes. Yeah, that's why it can be customized. Right? If you want, you can negotiate with the Mudalali and tell him that you will settle at the end of the month. Right? Or you can tell him you'll settle him tomorrow. Or you can settle immediately if you have cash. Right? So you can customize. It comes within that framework. Whereas if it's exchange traded and you buy shares, you will have to pay for it on the third day after purchasing T+3. Clear? Did I answer your question?
There's no time period for the trading hours also, no?
Yeah, everything is standardized. Because, now, for example, some exchange is open from 11 to 2:30. But you can't go at 5 o'clock and ask shares. Right? Even the opening time is standardized.
Okay, sir.
Okay? Right? How do you identify security? Like all of us, even bonds, of shares, or even debentures will have something like an NIC number. Which is called the ISIN number, International Security Identification Number. Right. Now, each of us, the NIC number we have is unique. No, there won't be two people with the same NIC number, right? If by any chance there is, then there would have been some sort of mistake. It is not possible. So likewise, treasury bills and bonds will also have ISIN numbers, right? Even shares will have ISIN numbers, or even debentures. If you take a treasury bill, the treasury bill will go like this. It will say the ISIN number is LKA 364. This example 14E097, right? So the first three digits, LKA means, LK means it's a Sri Lankan government security. Right? So if it's US, it will go as US. A means treasury bill, right? If there are two types, no, treasury bill and treasury bond. So A is treasury bill, B is treasury bond. 364 means the number of days there is until maturity, right? So this case, when this bill was originally issued, 364 days until it matured. So if it was a 91-day treasury bill, then it would have been 091, or that is a 3-month treasury bill. 6-month treasury bill is 182 days, so it would have been LKA 182. Next comes the maturity year. Which year is this maturing? Right? 14 means 2014. E is the month. Which month? Right? Because when you do treasury bills and bonds, you need to know the alphabet. Right? You can't do anything if you don't know the alphabet. But you don't have to memorize everything. You have to go from A up to the 12th month. Right? 12 months for a year. No? So you have to A, B, C, D, E, F, G, H, I, J, K, L. Up to L, you have to memorize if you want to do treasury bills or bonds, right? No need to memorize beyond that. So it's LKA 36414. E is the 5th month of the year, which is January, February, March, April, May. Okay, so you need to memorize the first 12 letters and the 12 months of the year. 09 is the maturity date. When is this treasury bill maturing? Okay, now in this case, the bill is maturing on 9th May 2014. 9th May 2014, and it has the last digit is called the check digit, right, which is a random number. Now, if I give you an example, right, we'll come back to the example. Okay, so this is a treasury bond. The first two letters, A is Sri Lanka, B is for bond. 005 means when the bond was originally issued, it had 5 years until it matured. Right? So this bond would have been issued 5 years before the maturity date. 15 is the maturity year. It's maturing in 2015. G is A, B, C, D, E, F, G, the 7th month of the year, which is July. So this bond is maturing in July 2015, and the next 15 is the date, 15 July 2015. The last number is the check digit, right? A random number. Let's say bill. $182 treasury bill. And I'll give you the check digit. Let's assume the check digits are 5. Right. So in both cases, let's assume the tech digits are 5. Can you all give me the IC number for the two of these? What are the IC numbers? It's a bill, would be LK. It's a bill, so LKA 182. It would be actually bill maturing in 2021. It's L175. And the bond would be LK. It's a bond. It's B 05 21 L 015. Yes, you all are right. Okay, so that's how the ISINs would go. Right. Now let me ask you a simple question, something we have learned in grade 2. What are the differences between a treasury bill and a treasury bond? Differences between treasury bill and treasury bond.
Treasury bill short term and treasury bond long.
Short term, treasury bond, long term. Very good answer.
Treasury bills have a maturity.
Treasury bills
Have a maturity.
and treasury bonds.
Long term maturity.
Yeah, so the
Or
same.
no maturity.
Treasury bills have a shorter term maturity, treasury bonds have long term maturity. Okay, now before we go any further, your answer is right. If you write this answer, you won't get any marks. No marks. Why? What is the reason?
Tenor should be mentioned, is it?
Huh? Pardon?
Do we have to explain it?
Yes, it's like this. Now you have to write a complete answer. Right? So if you just write short term, long term, it doesn't make sense. Okay, classic
Right.
example in what I just wrote. Sorry, before we do that, now if this is a 25-year bond, right? If this was a 25-year bond, then what would the ISIN be?
LKBO25.
Yes. This will be 025. Right. Okay. Let's keep it like this. Now, in this example, which one is maturing first?
T-bill. Treasury bill.
Bill. When is the bond maturing?
1st of December.
Yeah, 1st of December 2021. Whereas the bill is maturing on?
17th.
Huh?
17th.
17th. Right. So which one is short term, which one is long term?
T-bill is
Treasury bill is short term and treasury bond is long term.
No, no, no. Which one is maturing first?
T-bill is maturing first.
No,
Date-wise,
Treasury bond.
because in the
Yes,
calendar,
it's January December 1st.
in the calendar that I know, 1st of December comes before 17th of December.
Yeah, T-bond is maturing first.
Ah, that's the thing. So the bond is maturing first, and you are telling it's longer term than treasury bill. Doesn't make sense, no? You got the point?
We have to mention maturity.
Yeah, maturity. Okay, so still the treasury bond is maturing first, isn't it?
So no,
No, sorry, sorry to interrupt. No.
I didn't understand what you were asking.
Pardon?
I didn't understand it because it's for 25 years, right? T1
Yeah,
is
right. Okay, what about this? And let's say this is the bond is maturing on 1st of September. And it's in the next two. Okay. This one, bond is maturing next week, in 2 days, 1st of September. Bill is maturing
next year.
next year. Huh? So this could even have been beyond February. Understood? So which one is longer term of these two? The bill of the bond. Which one is the shorter term? Okay, I'm asking a very simple question. Is it maturing sooner? So which one is maturing earlier?
Bond is maturing earlier.
Bond is maturing earlier, and bill is maturing after that. So how come bond is long term, treasury bill is short term? It doesn't make sense, no?
Yes.
Then how do you fine tune this answer? But the answer is correct. You know the answer. Just a matter of how it's like you the correct answer. It makes sense. Just taking short term, long term doesn't make sense. This is the students make mistakes. And they know the answer, they have it in their head, but they don't write it down. And what they write doesn't make sense. Okay, so it's a matter of just getting in very simple English. How to write a proper answer for this? And this is the art of learning to write answers. It's a skill. If you have knowledge and you don't know how to write the answer, then it's a disaster. It's a recipe for failure.
Then we supposed to mention like treasury bill matures in 90, 180, 360 days, whereas treasury bond matures in 2 to 30 years like that.
Treasury bill, it's difficult to give exact number of days. Now from 17th February 2022, right? And today is August 29th. How many days? $172. Right, so you can't say treasury bill matures in 182 days because this month matures in 172 days. Right, your answers are correct. What you should say is at the time of issue, treasury bills have maturity. What do you think? When a treasury bill is first issued, it will have a maturity. What? How do you complete this?
Less than 2 years.
Less than 1 year. Whereas bonds, how would you write the same thing for bonds?
More than 1 year.
Don't just say more than 1 year. You need to give a full answer. This is where you have to practice. And practicing these answers, writing these answers is a skill which you can't master overnight. You have to keep practicing. Right? You can't study today and sit for the exam tomorrow. Because you have to master the art of writing answers. The comprehensive answer would be at the time of issue, especially bonds, have a maturity of more than 1 year. Clear? Understood? Hello? Is that clear?
Yes, sir.
Okay. Right. So what are the other differences? So it's good that you all are making these mistakes, otherwise you will never learn. and you will learn only if you answer. Any other differences?
Treasury bills are usually issued at discount to the face value, whereas treasury bonds are issued at the face value.
Okay, treasury, you're quite right. Treasury bills are always issued at a discount. Treasury bills are always issued at a discount. The bonds can be issued at discount, par, or a premium. This means if face value or the par value. Right? Now this means, the face value of the par value means the amount that you get when it matures, how much you receive when it matures. And that's called the face value or the par value. If the face value or the par value is 100, discount means what? More than 100 or less than 100?
Less than.
Less than 100. Less than 100 is discount. Discount means if it's less than 100. Right? Par means 100 or the face value. All this, the face value. Discount means less than the face value. Par means face value. And premium means more than face value. The bonds can be issued at less than the face value, at par, or at greater than the face value. Right? That's any other differences? Treasury bills have, yeah. What are you going to say?
They have default risk.
Uh,
Treasury bills and treasury bonds, if they issue it through corporates, then they might be having exchange rates and interest rate risk there.
yeah, if it's whether it's a treasury bill or a treasury bond, you definitely carry interest rate risk, right? That is correct. Only thing, a treasury bill or treasury bond does not have default risk. There is no default risk, right? Reason is, if a government runs out of money, they only have to print money, right? That's unlike corporate debt. Okay, so there is no default risk. Corporate debt, if the corporate cannot settle, then the default treasury bill or treasury bond, there is no default risk. That's a similarity. Guarantee the government will pay you back. It's local currency. Which means if it's foreign currency, then there is default risk. What else? Treasury bills, there is no coupon. Treasury bonds will carry a coupon unless it is a zero coupon bond. Understood? Zero coupon bonds. Now, coupon means if you buy a treasury bond, every 6 months you get an interest payment. And that payment is called a coupon. Whereas if you buy a treasury bill, you will never get a coupon. These are the similarities and differences between treasury bill and treasury bond. Right. So if a treasury bond, we'll leave treasury bills for a moment. Talk about coupons, so it's definitely, it has to be treasury bond. Whether how you figure out whether it's trading at a discount or a premium is one thing is you can look at the price, right? If the price is less than face value, then it's trading at a discount. If the price is sorry, if the price is less than the face value, it is trading at a discount. Write it underneath. Okay. If the price is, so the face value is 100, and if the price of this bond is less than 100 or less than the face value, it's trading at a discount. If it's equal to the face value, it is trading at par, or if it's more than the face value, it is trading at a premium. Now, there is a relationship between the coupon rate and return, right? How it works is the yield for your return is more than the coupon. Which means if the yield is more than the coupon, it is trading at a discount. If it's trading at a discount, then definitely yield will be more than the coupon. So we'll come back to this concept later, but for now, then if a bond is trading at par, the yield will be equal to coupon. And if a bond is trading at a premium, yield will be less than coupon. I will come back to these concepts later. But now you need to remember this. Okay. So if a bond is trading at a discount, then the price is less than the face value. That means the yield is more than the coupon. If it's trading at par, the price is equal to face value and coupon is equal to yield. And if the bond is trading at a premium, the price is more than face value, coupon is less than the yield. Yield is less than the coupon. Okay. Question is on sovereign risk. Does it have any impact on treasury bills and bonds? Well, unless you're a foreigner. Right? If you're a foreign investor, only this applies, sovereign risk. So if you're a local investor, it doesn't apply because the difference is if you're a local investor, you bring rupees and invest. But if you're a foreigner, you will convert your dollars into rupees and then invest, right? So when you convert it back into dollars, if the government does not have dollars, you will not get your dollars. You will only get your rupees. Right? So sovereign risk is different. It applies if the government has issued sovereign bonds or if a foreigner has invested in bonds. Yeah, open will come back. Asha, you will have to go back and listen. Right? Okay. And you will be able to catch up. Right. So the basic terminology of bonds, right? Issuer means the borrower. Who is borrowing will be issuing bonds. Right? So if the government issue bonds or bills, like what we saw earlier, the government and that is the government is the borrower, so they are issuing treasury bills or bonds. If a corporate is borrowing, they will issue debentures, right? So debentures or bonds are always issued by the issuer. Although the term is different, debentures and bonds, the principle, underlying principle is the same, right? So if you know bonds, you know debentures, same concept. Par value is the value that you get when the bond matures. Issuer is the entity that promises to make a payment. It agrees to pay at specified date consisting of interest. These are called coupons, right? So if it's a 5-year bond, let's say it's a 5-year bond. Let's say it's a 3-year bond for convenience. 3-year bond. Annual coupon payments. Face value, let's say, is 100. Coupon, let's say, is 10%. Yield, let's say, is 12%. Right now, face value means the value that you get when the bond matures. Face value you receive when the bond matures. In this case, the bond matures in 3 years. So at the end of the deal, you get the face value. Coupon is how much you receive every year. It's calculated as 10% of the face value. Every year, that means you get a coupon of 10. Until one matures. Yield is the return that you make. Right? So the return comes partly from the coupon as well as what we just discussed, right? Discount. So if you buy anything at a discount, then your return is high, isn't it? Now, just imagine if you had purchased a pen, right? If you had purchased a pen at a discount, if this pen is trading for 100 rupees and you bought it for 50 rupees, that it means you have bought it at a discount, right? So if you buy it at a discount, your return is higher now. But if you had paid 200 rupees for this, then your return is lower. So that is why yield or the return about IRR. Remember we did this calculation? The discount rate at which the present value becomes zero. If you discount this bond at a rate of 12%, you will get the price. These cash flows you need to discount at the rate of 12%, which is your return. Then you will end up with the price. Okay. So the total return of 12% you get is comprised of the coupon, which itself is 10%, and the discount at which you're buying. Now in this example, yield is 12%, coupon is 10%. So yield is more than the coupon, right? And if you go back to this concept, if yield is more than the coupon, you are buying at a discount. When you buy at a discount, your return is higher, right? So your return is actually higher than the coupon of 10%. 10% plus a certain percentage actually comes to 2%, which is why yield ends up being 12%, right? Now, if you had purchased it at 10% itself, maybe if you purchased at 10%, right? So if you take the coupon, return of 10%, so it's purely the coupon that you receive. Okay, so if yield is equal to coupon, and in this case, if yield is equal to coupon, then your one price will be equal to the face value of 100. But if you're buying at a premium, let's say you're buying it at 5%. Okay. Your coupon is 10% means your coupon is giving you 10, but your return is 5%. That means you must have paid something additional. So you're buying the pen for 200 rupees. It's worth 100, but you're buying for 200. Right? So your return will be less. Understood? That's how the price and yield relationship works. Yes, Kaushal, the institute will upload it. So the issuer agrees to pay specified on specified dates in principle, right? So interest is the coupon that he pays. On given dates, he will pay the coupon. Okay, so the issuer is bound to pay the coupon rates plus the face value when the bond matures. That is the responsibility of the issuer. Types of issuers. Government can issue treasury bills bonds, obviously. Government-related agencies, right? Maybe sometimes the Colombo Municipal Council. This doesn't happen often in Sri Lanka, but overseas can happen. Right? Maybe Ceylon Electricity Board, they can do it, or the Urban Development Authority, UDA. If you are related to government, you can raise funds through fixed income. Municipal corporations, supranational governments. Supranational means a collection of governments like the EU, they can get together and issue bonds. Next one is the par value, which we have already discussed. It is the amount that you receive when the bond matures. Now, these terms might sound complicated, but if you just look at it in a simple layman's way, it's very easy, right? There is jargon, but no need to worry. Right? It means very simple, something very simple. Par value is the value the issuer agrees to pay the bondholder at the maturity date. Right? So, in the example that we just discussed, the amount that you receive when the bond matures is called the par value. The par value is 100. It's also called the face value. Coupon is the interest rate stated on the bond when it is issued. Right? So when the bond is issued, they will mention the interest rate. It's the rate the issuer is agreeing to pay annually. It is called coupon, and the holders used to receive interest by stripping off coupons and redeeming them. Now, this is the old practice. Right? Everything is now electronic, so you don't have to tear off your coupon and give. So it's called coupon. Before this electronic system was introduced, you were supposed to tear off your coupon and go and submit it to the central bank. Then only they'll issue a check. Right. So coupon, like calculated earlier, is based on coupon rate into the par value. Remember, example, it was 10% into par value of 100. Right. So every year you get a coupon of 10. Every year you get a coupon of 10. Coupon rate into the face value. Zero coupon bonds is a bond which has a coupon of 0, right? So in the example, if it was a zero coupon bond, if this was a zero coupon bond, your coupon rate would have been 0%. That means every year you get coupon interest of 0. Okay. That means the only cash flow, if it's a zero coupon bond, is the value that you get when it matures. Right. Now, if it matures, when it matures, if you're getting 100, and if you invest 100 today by any chance, you're not getting any other cash flow in between, right? Then your return is maximum will be 0 now, isn't it? Best case, your return will be 0, right? Otherwise, you get negative return, which is why treasury bills are always issued at a discount. Okay, because if you have issued this treasury bill, or is it like a treasury bill, as a coupon bond, if you have issued this, the price of 95, then your return will be 5. You get 100 maturity, your purchase at 95. So you get like an interest payment of 5. But if it had been issued at 100, the interest will be 0. Okay, so that's why this will always have to be issued at a discount. But it's issued at a premium, it's 105. Then it doesn't make sense to buy this at all. Zero coupon bond is a debt security that does not pay interest. So you get a deep discount and redeemed by its full face value at maturity. Right? Zero coupon bonds are called deep discount bonds. Coupon bonds are debt obligations with coupons. The price of a bond. If you're buying a pen, but you pay the price. So likewise, if you're buying a bond, you need to pay the price of the bond. Price of a bond is the present value of future cash flows received by the bondholder. Okay. A present value is, have you all heard of present values? Never heard of? Never heard?
Heard.
Okay. Finally, you remember. Thank God. Okay, I thought you would have forgotten because this is something we discussed about 2 weeks ago. I know you all are suffering from short-term memory loss, and 2 weeks is a long time period. Right, so I was scared that all of them have forgotten. Present value is something we have done, and discounting cash flows, all that, right? So cash flows is the interest payment at the end of each period plus face value that you receive. Okay, so the cash flows, you have cash flows in this example, and cash flows need to be discounted at the required rate of return. I think we did one calculation last week. We didn't. What did we? I'm sure we did. Just vaguely remember us doing a bond calculation last week. Okay, so let's work on this example. I'm just in the deep end straight away. There's a bond with a face value of 100 maturing in 3 years, coupon 10%. That means every year you get a coupon payment of 10. Yield is 10%. The total cash flow yeah. I'm sure we did a cash flow a calculation last week. Of course, you may have forgotten. Right, so these are your cash flows. Then the discount factor. You need to discount at what rate? You need to discount these cash flows at
12%.
At 12%, yes. If you have your discounting factors, then you calculate present value. should be the cash flow into discounting factor. Value is the total of present values. Net present value is nothing but the price of the bond. Is that clear? Right? Did you understand this? If you were to buy this bond, how much have you got to pay? Yeah. Hello. If you all wanted to buy this bond, how much have you got to pay?
$95.20.
Very good. Very good. So if you want to buy this bond, you have to pay 95.20. The next question is, if you are buying a bond, it's a cash inflow or an outflow? If you're buying something, cash comes in or goes out?
Inflow.
Okay, so when you buy a pen,
No, outflow.
it's an outflow, yes. Right. So you're buying this bond at a price of 95.2, which is a cash outflow, right? Now, can you tell me the IRR of these cash flows? What is IRR? Have you all heard of IRR?
Yes, sir.
Okay. What is the IRR of this bond? Got the question? Understood? What is the IRR of this bond? Yeah. Right. Shall we find the net present value of this entire exercise? What happens if you today for 95.2? So let's discount it. Yep, 12%. And calculate present value. Discount. Comes to 0. Correct. Discount this entire exercise or the process of buying the bond and holding it until maturity and discount it at a rate of 12%. And 8% value comes to 0. So my next question is, what is the IRR of this project, entire exercise? IRR. What would be the IRR? Yeah. Can you remember the definition of IRR? Yes, you have answered. I did not know this. Yeah, it's the discount rate at which net present value is 0, right? So you discount at 12% and you get a net present value of 0 means the IRR of this bond is 12%, right? So you have earned a return of 12% on this bond. Okay. Now let's get back to our previous concept. The yield on this bond is 12% for this area. The yield is 12%. Coupon rate 10%, face value 100, right? Now yield is more than the coupon. So if the yield is more than the coupon, that means the price should be less than face value, isn't it? See this one. If the yield is more than coupon, price should be less than face value, right? And it's going to discount. Which is correct, right? Our price is 95 and face value is 100. Right? Sorry, face value is 100. Price is 95. When the yield is more than the coupon, the bond rate at a discount. Can we do the same calculation? Same thing when the yield is 8%. What happens when the yield is 8%? Coupon remains at 10. So cash flows first year 10 coupon, second year coupon of 10, third year coupon of 10, and face value of 100. So you get 110 during third year. Discount factor will change. It will be 8%. You get a price of 105.15. What is the IRR of this? IRR. What would be the IRR of the second example? Second example, what is IRR? They are buying it at a price of 105. The discount rate is 8%. So what is IRR? IRR is nothing but the yield, isn't it? Yield is IRR, right? It's 8%. Okay. Any questions, guys? No questions? Right, so let's try these examples. Shall we try this? First one is a bond that matures in 6 years and is valued at 1,000, and annual coupon payment of $80 and market interest rates of 9%. What is the price? Shall we calculate? This is a bond that matures in 6 years, value of 1,000. So par value, remember, need not be 100. It will be given as the exam. Usually, if it's not mentioned, you take it as 100. But if it's given as the exam, then you don't try to argue. You don't say that par value should always be 100. There's no such thing, right? You work on based on what is given at the exam. Payment of 80. Every year you get a cash flow coupon of 80. Coupon 80. Which means that maturity, how much you get when it matures? When this bond matures, how much will you get?
1080.
1080, very good. Discount rate.
The Excel isn't visible.
Yeah, okay, actually. Market interest rate of 9% means you're discounted at 9%. Try to give the discounting factor in 4 decimals. Present value is the cash flow into discounting factor. So the net present value or the price of this bond comes to 955. Okay. Now, before you do any calculations, right? See the discount factor, discount rate, coupon 8%. So the yield is 9%, coupon is 8%. So the yield is more than the coupon means the price of the bond should be less than face value. Right? That means the bond is trading at a discount. Face value is 1,000, so the bond will have to trade at below 1,000. Meaning, by any chance, if you had got an answer of 1,500 or anything more than 1,000, then your answer is wrong. That's a very basic way of checking whether you got the right answer. Clear? Did all of you this answer? Unfortunately, you'll have to try and get used to doing it manually. Yeah? The exam Excel is not allowed now. Well, I know since I've been using Excel with you all, I come to think of it that Excel should be allowed in the exam. Exam can be made online even. Explain what, Shashi? Sorry, I'm not sure. Explain. Well, the calculation should presume you understood the calculation. Did you understand the calculation? Okay. What I was saying is now the yield of this bond, if you go to the question once again, market interest rate is 9%. In other words, market interest rate is the return that you get is 9%, and the coupon payment is 80 now. Like coupon payment 80 means what is the coupon rate? If the coupon payment is 80, what is the coupon rate? Face value 1,000, coupon is 80. Coupon is 80. Yeah, coupon is 8%, right? So your yield is 9%, coupon is 8%. Yield is more than the coupon. If yield is more than the coupon, what did we discuss earlier? The bond is trading at a discount. That means the price should be less than face value.
Yeah.
Face value is 1000. So the price you get should be less than 1000. And you get 955, which means the answer should be correct. But by any chance, if you did a calculation and you ended up with an answer of more than 1000, right? If you got maybe 1050, for example, that means your answer is definitely wrong. Okay, because your yield is more than the coupon. So definitely your price will have to be less than the face value. Clear, Shashi? All right. Any more questions? Okay, so let's try the next question. The bond has a 15-year maturity, 10% annual coupon, $1,000 par value. Required rate of return on the bond or the yield to maturity is 10%. Given its risk, maturity, liquidity, and other rates in the economy, what is the fair value of the bond? Or in other words, what is the market price of this bond? What do you think? What is the value of this bond?
1,000.
Shall I calculate? Yes, I think Ramdas has got it right. Right? You don't have to do any calculations. See, a bond has 15-year maturity. Let's read it carefully again. 10% annual coupon. Coupon is 10%, $1,000 par value. The required rate of return or the yield to maturity on this bond is 10%, right? So coupon is 10%, yield is 10%. If the yield is equal to coupon, what is the price? If yield is equal to coupon, the price should be
1,000.
1,000, exactly. Right, so you don't have to do any calculations. At the exam, try and use shortcuts wherever possible. Right. So this is the bond calculator. In other words, the formula to calculate bonds. Very simple, no? This is actually how you calculate a bond price, right? Isn't it? And you have to memorize this. No, I'm just kidding. You don't have to memorize, right? Go by the basics. But if you look at it, now let's go back to our Excel sheet once again. These cash flows, you're receiving the same cash flow over a period of 6 years. Right? 80 you receive over a period of 6 years. 60, of course, you receive. I'll write it down once again. This value is 1,000. If you look, calculate these cash flows, you're receiving the same amount of coupon every year for 6 years. That's receiving the same amount, so the same cash flow over a period of time is called what? This is something we covered about 2 weeks back. Again, a long time, so I know there is short-term memory loss, but if anyone can remember, if you receive the same amount of cash over a period of time, what's it called? The same cash flow which you receive over a period of time is called?
Annuity.
Yeah, very good, annuity. Right? So this is an annuity. And here you have the future value, right? So the total cash flow is the total of annuity and future value. Annuity plus the face value. That is the total cash flow. Okay. Which means the present value, net present value will be equal to present value of annuity plus present value of the face. If you go back to this equation, the breakdown of this equation, now this is the periodic coupon that you get. Right? C denotes the coupon, and this is the annuity formula, the present value of an annuity formula. Right? If you go back and look at your notes, you'll see that this is the present value of an annuity formula. Plus, M is the maturity value, and you're discounting it. Right? So this is the present value of the annuity plus the face value discounted. Right? That gives you the price of a bond. Understood? Discount of an annuity and the face value. This is what we discussed earlier. Right? Premium and discount bonds, also par value bonds. So remember, if the coupon is, if the yield is more than the coupon, it's trading at a discount. If the yield is equal to coupon, it's trading at par, and if the yield is less than the coupon, it is trading at a premium. Term to maturity is when the bond matures, how long it has until maturity, right? When a bond is first issued, if it's a 25-year bond, and if it's issued today, it will mature in 2046. But 1 year down the line, it will have another 25 years to mature, right? So that is the outstanding term that it has to mature. The time between when a bond is issued and when it matures, at which time the issuer must redeem the bond or pay the principal by paying the principal. Or the amount of time between now and when a bond matures is called term to maturity. Okay. Any questions up to now? Do you have any questions? No? You understood everything? Right. Looks like we have run out of time for today. So if there are no questions, we can wind up. And we meet next Sunday at the same time. Right. So we will continue from where we stopped on. It's GSEC terminology.